Have you ever taken a trade right before the market reversed, or missed a huge move and felt frustrated watching price run without you? You're not alone, and that's exactly why I made this video. Today I'm going to show you 3 candlestick signals that actually work, and how to use them to catch high probability trades on any market or time frame. Here's what you're going to learn in this video: the deceptive candle, how to spot liquidity sweeps and trap traders before the market reverses; the power shift candle, how to catch the exact moment when buyers or sellers take full control of the market; the second chance candle, how to join a strong move even if you miss the first entry without chasing price. These strategies work in Forex, crypto, stocks, and commodities, and they apply to any time frame, whether you're day trading, swing trading, or even position trading. Before we dive in, make sure to like this video, subscribe to the channel, and hit the bell so you don't miss any future trading lessons. Let's get started. The deceptive candle is the market's lie, a candle that sweeps liquidity and then reverses, trapping traders on the wrong side of the market. Let's start with its structure, because recognizing it visually is the first step. A deceptive candle has a small body and a long wick, showing that price moved aggressively in one direction, but failed to stay there. If the wick is at the bottom, price pushed down, triggered stop losses, and then closed back higher. If the wick is at the top, price pushed up, tempted buyers to jump in, and then closed back lower. But here's where it gets interesting. This isn't just a pretty candle pattern, it's a liquidity grab. When price dips below support or spikes above resistance, it's not by accident. The market is hunting for liquidity, stop losses from trapped traders and breakout entries from impatient ones. That extra liquidity gives smart money the fuel to enter their positions at the best possible price. And this leads us to the real power of the deceptive candle. It's psychology. This candle represents pain for one group of traders and opportunity for another. Retail traders see a breakout and rush in late, thinking they're catching the move. But smart money uses that exact moment to load up in the opposite direction. When the candle closes back inside the level, it confirms the trap and shows you where price is likely to go next. Now you might be asking, what's the difference between the deceptive candle and a regular pin bar? Technically, they look very similar. Both have small bodies and long wicks. But here's the key difference. A pin bar is just a description of how a candle looks, while the deceptive candle is about what the market is actually doing behind the scenes. A regular pin bar can form anywhere, in the middle of a range, randomly on the chart, and it means nothing by itself. The deceptive candle, on the other hand, forms at a key level after price sweeps liquidity. It tells you a story, that smart money just trapped the other side and is ready to move the market in the opposite direction. So the deceptive candle isn't just a shape, it's a trap signal with context. That's why I renamed it. I don't want you to think of it as just a textbook pattern. I want you to see the story, the liquidity grab, and the opportunity it creates. Now that you know what the deceptive candle is and how it's different from a regular pin bar, let me show you how I actually trade it using my TLS method. TLS stands for trend, level, and signal. The first thing I do is analyze the market. As you can see on this US dollar, Canadian dollar 1-hour chart, the market is clearly trending up. That's our first condition, a trending market. The second condition is the level. Notice how price broke this resistance level and then came back to retest it. When price touched this level, which is now acting as support, it got rejected and formed a clear deceptive candle. This rejection isn't random. The deceptive candle just created what we call a liquidity sweep. Price grabbed all the stop losses sitting below this level and then reversed. That's a strong sign the market is likely to continue moving higher. So now we have the full TLS method in action, a clear trend to the upside, a strong support level, and our signal, the deceptive candle. Before entering the trade, I always check the reward to risk ratio. In this example, the trade offers more than 2-to-1, which means it's worth taking. The final step is to confirm with the higher time frame. When I switch to the higher time frame, I can see the market is also trending up. Price broke through this key resistance, pulled back, and once it retested the level, now acting as support, it swept liquidity and pushed higher again. This tells me buyers are still in control and price is likely to continue higher to reach the next resistance level. This perfectly supports our trade setup on the 1-hour chart. Now, let's go back to the 1-hour time frame to execute the trade. To take this trade, I place my entry at the close of the deceptive candle, put my stop loss just below the wick, and set my target at the next resistance level. And look at what happened next. The price went straight to the target as expected. That's the power of combining the deceptive candle with the TLS method. Now, let's flip the script and look at a downtrend example. because the deceptive candle works just as well when the market is falling. Here, the market is making lower highs and lower lows. That's our first condition, a clear downtrend. Next comes the level. Price rallies back to retest a previous support that has now turned into resistance. This is where smart money usually waits to sell. Right at that level, we see a deceptive candle with a long upper wick. Price spiked above resistance, trapped breakout buyers, and then slammed back down. That's our liquidity sweep, and it signals that sellers just regained control. Now we have all three TLS conditions lining up. A bearish trend, a key resistance level, and our signal candle. This gives me confidence that the next move is likely down. For the trade, I place my entry at the close of the deceptive candle, stop loss just above the wick, and target the next support level. The reward to risk is better than 2-to-1, which makes this setup worth taking. And watch what happens next. Price sells off perfectly, hitting our target. That's how you catch high probability trades in a downtrend without guessing. Before you can trade the deceptive candle, you need to know what kind of market you're in, because a signal without context is just noise. An uptrend is simple. Price makes a series of higher highs and higher lows. Every dip gets bought, and every new push breaks the previous high. In an uptrend, buyers are in control. Big players are buying low and selling high. That's why price respects support levels again and again. When you see a deceptive candle form at a support zone inside an uptrend, that's usually smart money loading up for the next leg higher. A downtrend is the exact opposite. Price makes lower lows and lower highs. Every rally gets sold off, and each drop breaks the previous low. In a downtrend, sellers are in control. Smart money is selling into rallies and taking profit lower. A deceptive candle near resistance in a downtrend often means they just trapped buyers before continuing lower. But sometimes the market isn't trending at all, it's moving sideways in a range. Price keeps bouncing between support and resistance, and no one is really in control. In a range, buyers and sellers are fighting for dominance. Smart money uses this time to accumulate or distribute positions. If you trade deceptive candles blindly inside a range, you'll get chopped up. Instead, wait for a breakout and then a retest. That's where the high probability trades come from. So before taking any trade, ask yourself, are we trending up, trending down, or just ranging? Because the deceptive candle only works when it lines up with the market story. In a trending market, you ride with the big players. In a range, you stay patient and wait for the breakout before jumping in. So that's how I use the deceptive candle with the TLS method to catch high probability trades. But the deceptive candle isn't the only signal I rely on. There's another one that's just as powerful, and in some cases even stronger. It's called the power shift candle, and this one doesn't just reject price, it takes over the entire chart. The power shift candle is exactly what it sounds like. It marks the moment when control shifts from one side of the market to the other. Technically, it's a candle that completely engulfs the previous one. If it's bullish, it closes above the high of the previous candle, showing buyers just wiped out the selling pressure. If it's bearish, it closes below the previous candle's low, showing sellers just took full control. The psychology here is fascinating. When the power shift candle forms, it does two things at once. Washes out weak hands. Traders who were against the trend get squeezed out as price closes beyond the previous candle's range. Invites fresh momentum. Traders who were waiting for confirmation jump in, adding fuel to the move. This combination creates strong momentum in the direction of the power shift candle. Let's clear this up. A power shift candle is not just any engulfing bar. An engulfing bar can appear anywhere, in the middle of a range, during a choppy market, or even against the trend, and most of those fail. That's why many traders lose money trading them. They take every engulfing bar they see. A power shift candle is different. It only matters when it forms in the right place, like inside a supply or demand zone, an order block, a breaker block, or right after a liquidity sweep. When you combine the right location with a strong engulfing move, it's no longer just a candle pattern. It's a clear signal that smart money just entered the market. Let's take this one step further and combine the power shift candle with supply and demand zones. This is where it really shines. Here's a clean chart of the British pound US dollar on the 5-minute chart. Notice how price drops sharply from these two areas, the first supply zone and the second supply zone. These are smart money zones, meaning there were a lot of sell orders placed here in the past. Now price rallies back into the second zone. This is where we expect smart money to step in again, defend their positions, and push price lower. Right here we get our signal. The first candle is a deceptive candle, but the one that really matters is the second one, a bearish power shift candle. It completely engulfs the previous bullish candle and closes near its low. That's our clue that sellers have just stepped back in and shifted control of the market. Before I take any trade, I always check two final conditions. First, does the setup give me at least a 2-to-1 reward to risk ratio? In this case, the risk to reward looks perfect. I'm risking a little to potentially make at least twice as much. Second, I confirm with the higher time frame. Let's take a look. On the hourly chart, our higher time frame, the market is trending down. It will likely keep dropping until it reaches this demand zone. That means we still have room to trade on the 5-minute chart. When both of these conditions are met, that's my green light to execute the trade with full confidence. Now let's switch to the 5-minute chart. Here's how I execute the trade. I place my entry right at the close of the power shift candle, set my stop loss just above the power shift candle, and place my target at the next support level below. This setup gives a 2-to-1 reward to risk ratio, which is exactly what I'm looking for. Before we move on, here's an important note. You can't just take every power shift candle inside a zone. You need to be selective, and that's why I use 4 criteria to filter out weak zones. Let's go through them one by one. The first criterion is strong, clean candles. When institutions step in, they move the market with power. Large candles, all moving in the same direction. That's the footprint you're looking for. If the zone is made of small, choppy candles with lots of wicks, I skip it. Weak momentum means weak zones. The second criterion is freshness. I only trade fresh zones, ones that haven't been touched before. The first reaction is usually the most explosive. Every retest after that makes the zone weaker, so I avoid used up levels. The third criterion is a break of structure. The best zones form right after price breaks a key high or low. That break grabs liquidity, traps traders, and shows smart money is in control. A zone formed after a structure break is a zone worth watching. And the fourth criterion is risk to reward. Even if everything else looks perfect, I won't take a trade unless the setup gives me at least a 2-to-1 reward to risk ratio. That's how I stay profitable over the long run, even with losing trades. Okay, so remember, strong candles, fresh zone, break of structure, and solid risk to reward. If even one of these is missing, I skip the trade. No criteria, no trade. Simple as that. Now let me walk you through a clear example so you can see exactly how this works in real time. This is the Euro-US dollar 5 minutes chart. Right here, the market formed a beautiful demand zone. Look at the candles that created it. Strong, clean, and all moving in the same direction. Even better, this zone is fresh. Price has never touched it before. Notice how the previous resistance level was broken, confirming a shift in market structure. And when we measure our setup, the reward to risk ratio is excellent. Now look what happens when price comes back into this zone. We get a strong bullish power shift candle, our signal to get ready. But before pulling the trigger, we always check the higher time frame for alignment. On the hourly time frame, the market is trending up. It makes a move higher, pulls back, and then moves up again. This tells us price is likely to keep going higher, perfectly aligning with our bullish setup on the 5-minute chart. That gives us the confidence to execute. Back on the 5 minutes chart, here's how I take the trade. Entry goes right at the close of the power shift candle, stop loss just below the demand zone, and target set at the next major level above. And watch what happens next. Price reacts exactly as expected, bounces hard off the zone, and rallies straight to our target. This is the power of combining a fresh demand zone, a power shift candle confirmation, and higher time frame alignment. It's not just a trade, it's a trade with context and conviction. Let's look at a quick example on the Australian dollar Japanese yen 5-minute chart. Notice how price had a sharp sell-off earlier, leaving behind a very clear base of candles where that move started. That's our supply zone. The drop was clean and aggressive, which tells us sellers were in control, exactly what we want to see. Instead of chasing the move, we let price come back into the zone. Patience is key. And right here, price finally revisits the zone for the first time since it was created. Inside the zone, we get a decisive bearish power shift candle that swallows the previous bullish candle and closes near its low. That's our confirmation that sellers just stepped back in. Now we jump to the 1-hour chart for context. The market has been trending down and moving in a range, but with clear selling pressure. This higher time frame bias adds even more confidence to our short trade idea. Back on the 5 minutes. Here's how I set up the trade. My entry is placed right at the close of the power shift candle. The stop loss goes just above the zone and the target is set at the next level below. Price rejects immediately, sellers take control, and we hit the target in just a few candles. This is the power of combining a strong supply zone with a power shift candle. You're stacking the odds in your favor. Now, let's move on to the third candle signal, the second chance candle. The second chance candle is what traders know as an inside bar, but we don't trade every inside bar we see. It's a two-candle pattern where the second candle forms entirely inside the range of the first, also known as the mother bar. Its high is lower than the mother bar's high, and its low is higher than the mother bar's low. Psychologically, this pattern tells us the market has paused after an aggressive move. Buyers and sellers are taking a breath, waiting to see what happens next. It's like the market is compressing before releasing energy in one direction. But here's the key, we call it the second chance candle because it gives you exactly that, a second chance to get into a trade after a big move. Here's a great example. We had a liquidity sweep at a key support level, price reversed sharply and shot higher. This was our first opportunity to buy. But if you miss that entry and you see a second chance candle form during the move, you now have another chance to catch the trend. All you do is wait for price to break out of the second chance candle in the direction of the move, then enter immediately with the trend. Now let's make something clear. Not every inside bar is a second chance candle. For a second chance candle to be valid, two elements must be present. Liquidity sweep. First, there has to be a clear liquidity grab, either above a resistance level or below a support level, taking out stops and trapping traders. Strong displacement. Second, the move after the sweep has to be strong and decisive. Big candles moving with momentum, not just sideways chop. Think of it like this. The liquidity sweep and the strong displacement are the train leaving the station. If you missed getting on, the second chance candle is like the train slowing down at the next stop, giving you one more shot to hop in before the trend continues. Okay, now let me give you a chart example. This is the British pound, Japanese yen, 1 hour chart. As you can see, the market touched this area and reversed, forming a clear resistance level. Later, price retraced back, broke slightly above this resistance, and then closed back below, creating a textbook liquidity sweep. This sweep tells us that sellers were trapped in what we call sell-side liquidity, and when that happens, smart money usually takes the price in the opposite direction, in this case, downward. Look what happened next. Price pushed down strongly, leaving no safe entry point, but then we get our opportunity. A second chance candle forms. This pattern is like a brief pause, giving us a second chance to get on board with the trend. Once we spot this candle, we simply wait for a breakout in the direction of the strong move. After the breakout, we now have a high probability trade opportunity. Before we take it, let's check the higher time frame. Switching to the daily chart, we can see the market is trending up. But notice this. A liquidity sweep occurred at this resistance level and price dropped strongly afterward. This signals a possible trend reversal and confirms that our 1 hour setup is aligned with the bigger picture. So we go back to the 1 hour chart and set up our trade. Entry at the close of the breakout candle, stop loss just above the second chance candle, and target at the next support level. And look at what happened next. Price continued lower and hit our target exactly as planned. This is why I love the second chance candle. Even if you miss the first move, you still get a clean way to join the trend with confidence. Let me show you another great example. This is the New Zealand US dollar 5-minute chart. The market was trending down, then hit this level and reversed, creating a new support. Price pulled back, broke below that support, and then closed back above it. That's a textbook liquidity sweep, and right after, we see a strong displacement to the upside. If you missed that first entry, no problem. Wait for the market to give you a second chance, and here it is. A clear second chance candle forms. Now we have two powerful signals lining up. The liquidity sweep, telling us the trend might be changing. The strong displacement, confirming buyers are in control. Before taking the trade, let's check the higher time frame for confirmation. On the 1 hour chart, price also broke below support and closed back above, another clear liquidity sweep, and moved higher. This higher time frame bias supports our buy setup on the 5-minute chart. Back to the 5-minute chart. Here's the plan. We wait for price to break out of the second chance candle, enter at the close, place our stop just below the candle, and target the next major level. And look what happens next. Price takes off and smashes our target. This is the power of combining liquidity sweeps with second chance candles. It gives you clear, high probability trades with confidence. If you found this video valuable, hit that like button, subscribe, and share it with another trader who needs to see this. Trade smart, stay patient, and I'll see you in the next video.